Did you know that 90% of small businesses fail within their first 5 years? And the number one reason isn't a lack of customers or bad products. It's poor financial management. Today, we're diving deep into accounting basics that could literally save your business or personal finances from disaster. Whether you're starting a business, managing your personal money, or just tired of feeling lost when people talk about balance sheets, this complete guide will transform you from accounting amateur to financial genius. And trust me, by the end of this video, you'll understand why successful people always say that accounting isn't just about numbers. It's about making smart decisions with your money. Let's start with the foundation. Accounting is simply the language of business. Think of it as a universal translator that turns all your financial activities into understandable information. Every dollar that comes in, every expense that goes out, every asset you own. Accounting captures it all and organizes it in a way that tells the story of your financial health. The most fundamental concept you need to grasp is the accounting equation: assets equal liabilities plus equity. This might sound complicated, but it's actually beautifully simple. Assets are everything you own that has value. Your cash, inventory, equipment, even accounts receivable from customers who owe you money. Liabilities are what you owe to others: loans, credit card debt, unpaid bills. Equity is what's left over, essentially your true ownership stake in the business or your net worth personally. This equation must always balance, which is why we call it a balance sheet. If your assets don't equal your liabilities plus equity, something's wrong with your numbers. It's like a mathematical law of the universe for money management. Now, let us talk about the two main types of accounting that will change how you view money forever. Cash accounting is straightforward. You record income when you actually receive cash and expenses when you actually pay them. It's like keeping track of what's in your wallet right now. Most small businesses and individuals use this method because it's simple and shows real cash flow. Accrual accounting is more sophisticated and required for larger businesses. Here, you record transactions when they happen, not when cash changes hands. If you sell something today but won't get paid for 30 days, you still record that sale today. This gives you a more accurate picture of your true financial performance. The income statement, also called a profit and loss statement, is your financial scorecard. It shows whether you're winning or losing financially over a specific period. Revenue minus expenses equals profit or loss. But here's where most people mess up. They focus only on the bottom line without understanding the story the numbers tell. Your revenue should be growing consistently, but more importantly, you need to understand what's driving that growth. Are you getting more customers or just raising prices? Your expenses should be controlled, but not at the expense of future growth. The relationship between these numbers reveals whether your financial strategy is sustainable. Cash flow is the lifeblood of any financial situation. You can be profitable on paper, but still go bankrupt if you can't pay your bills when they're due. This is why cash flow management is crucial. Track when money actually comes in and goes out, not just when transactions occur on paper. Here's a critical insight most people miss. There are 3 types of business activities that affect your cash flow. Operating activities are your day-to-day business operations. Investing activities involve buying or selling long-term assets. Financing activities include borrowing money or paying back loans. Understanding which category your cash flows fall into helps you make better strategic decisions. Let's discuss the chart of accounts, which is essentially your financial filing system. Every transaction gets categorized into specific accounts: assets, liabilities, equity, revenue, and expenses. The more organized your chart of accounts, the easier it becomes to analyze your financial performance and make informed decisions. Budgeting ties everything together. A budget isn't just wishful thinking about your finances, it's a strategic tool that helps you allocate resources effectively. Start with your historical data, adjust for expected changes, and create realistic targets. Then track your actual performance against these budgets regularly. Financial ratios are your secret weapon for understanding what your numbers really mean. The current ratio tells you if you can pay your short-term debts. The debt-to-equity ratio shows how much you rely on borrowed money. Profit margins reveal how efficiently you convert sales into profits. These ratios help you benchmark against industry standards and identify areas for improvement. Here's something most accounting courses won't teach you: the psychology of money management. Good accounting isn't just about recording transactions correctly. It's about creating systems that support good financial behavior. Automate what you can. Review your numbers regularly, and always ask what story your financial data is telling you. Tax considerations should influence your accounting choices from day one. Different accounting methods can significantly impact your tax liability. Depreciation schedules, expense timing, and business structure all affect what you owe the government. Smart accounting planning can legally minimize your taxes while maximizing your wealth. The biggest mistake people make is treating accounting as a backward-looking exercise. Yes, you need to track what happened, but the real power comes from using that information to make better future decisions. Your financial statements should guide your strategy, not just satisfy reporting requirements. Technology has revolutionized accounting, making it accessible to everyone. Modern software handles most calculations automatically, but you still need to understand the underlying principles to make smart choices and catch errors. Mastering these accounting basics isn't just about better bookkeeping. It's about gaining financial intelligence that transforms how you make money decisions for the rest of your life.